Good day, this is the Asymmetric Daily Brief for Saturday, August 8th, 2026, covering Friday's close. Here is the shape of it. The American economy lost 23,000 jobs in July, and the S&P 500 closed at a record high the same afternoon. Gold ran higher, Bitcoin cleared $65,000, and the entire tape traded as though the Federal Reserve had just promised relief. But the rate market never priced a cut. It priced a smaller chance of a hike. That distinction is the whole day, and it is where we will start. Then the board, 3 places we think consensus has this wrong: the macro regime, sentiment, sectors, the calendar, and the calls. Board, the S&P 500 closed at 7,757.64, up 0.62%, and that is a record close. On the week it added 3.6%, its strongest week since April. The Nasdaq Composite closed at 26,690, up 1.3% on the day and 5.2% on the week. The Dow added 151 points to 54,036. The 10-year Treasury yields roughly 4.68%, and yields fell after the jobs print. Gold is around $4,358 an ounce, bid on a softer dollar and lower front-end rate expectations. Bitcoin is near $64,940, having traded as high as $65,300. Brent crude is $82.15, West Texas near $78.84. The dollar index sits around 99.6, and one number to hold alongside all of that. The top 10 companies are now more than 40% of the S&P 500. The largest 7 are about 34%, and Nvidia alone is close to 12.7%. A record index level is increasingly a statement about 10 companies. Consensus versus the asymmetric. First read, everyone believes payrolls went negative, therefore the Federal Reserve cuts, therefore buy everything with duration. The tell says nobody is actually forecasting a cut. What moved on Friday was the hike probability, and it moved down without moving through zero. Before the jobs report, futures put the odds of a September hike at 57%. After it, 43.9%. Over the same span. The probability that the Federal Reserve simply holds rose from 43.2% to 60.4%. Read those two moves together, and the conclusion is unavoidable. The market did not reprice from hike to cut. It repriced from hike to hold. A cut is not in the September distribution in any meaningful size at all. Here are the two numbers that set it off. Economists looked for a gain of roughly 80,000 jobs. The economy delivered a loss of 23,000, and the revisions did as much damage as the headline. May was cut by 66,000, June by 37,000, a combined 103,000 jobs that were counted last month and are not there now. Average hourly earnings came in at $37.62, up 3.2% year over year. For context on the policy setting, the federal funds target is 3.5% to 3.75%. held at the July 29th meeting, and the next decision lands on September 16th. Second read, everyone believes that print was a labor market collapse. The tell says it was mostly a shrinking denominator. Look at what the unemployment rate did. It fell to 4.1%. An economy that is genuinely cracking does not produce a falling unemployment rate. This one did, because the labor force participation rate dropped to 61.4%, the lowest in more than 5 years. With 264,000 people leaving the workforce in a single month, people who stopped looking stopped being counted. Meanwhile, wages still ran 3.2%. A real demand collapse gives you rising unemployment and decelerating wages together. We got neither. The softness is real, and the revisions are genuinely ugly, but collapse is the wrong word, and collapse is the word the tape traded on. Third read, and this is today's focus, so I will keep it short here. Everyone believes housing became unaffordable because of interest rates. The tell says it is the price-to-income ratio, and it predates every recent rate cycle. The 30-year fixed averaged 6.69% this week. That is lower than the roughly 7.8% a mid-1990s buyer paid. What actually changed is the multiple. The median American home now costs 5.08 times median household income, against 3.65 times in 1980. And the arithmetic behind that is simply that since 1980, prices rose 551%, while incomes rose 373%. Rates are the variable people can see. The ratio is the one that broke. Frankie has the full version in today's focus. So hold the three reads together. Hike 43.9, hold 60.4, a cut is not the debate. Follow the money, start with rates and inflation, because that is the engine everything else hangs off. The Federal Reserve held at 3.5 to 3.75% on July 29th. Friday's payroll miss knocked September hike odds to 43.9%. But the striking thing is what did not appear, which is any meaningful cut probability, and the reason is that the inflation side has not cooperated. The working assumption across the sell side is that inflation is running nearer 3% than 2%. That is why September is framed as hike or hold rather than hold or cut. Chair Kevin Warsh has said he would be willing to raise next month if inflation readings stay elevated. So the real event on the calendar is not the next payrolls report. It is the next consumer price index print. Now the dollar. And this is the most structurally consequential story of the week and the least covered. The United States Treasury participated in a coordinated intervention to support the Japanese yen. Treasury Secretary Scott Bessent confirmed the action and signaled a readiness to do more. The dollar index fell to a 7-week low near 99.4 on August 3rd and sat around 99.6 on Friday. Strip out the mechanics, and the message is uncomfortable. The issuer of the world's reserve currency is spending resources to defend somebody else's currency because a disorderly yen forces Japanese institutions to sell the asset that funds the American deficit. That is a treasury market story wearing a currency market costume. Crypto and policy. Bitcoin cleared $65,000 intraday on the jobs miss and settled near $64,940. Separately, the Senate left for August recess without a floor vote on the Clarity Act, and a great deal of the crypto press immediately declared the bill dead. It is not. The majority leader filed the first-stage cloture motion, which cues an initial vote when the Senate returns on September 14th, and Coinbase's chief executive. The party with the most to lose publicly thanked him for the September commitment. The accurate framing is delayed, with a procedural vote already teed up, not killed. And worth noting, public prediction markets never priced passage this year above the mid-teens, so the shock was only a shock to headline readers. Gold, meanwhile, sits near $4,358 an ounce, and I will give you the level and the driver. A softer dollar and lower front-end expectations, rather than repeat a year-to-date percentage I cannot stand behind. Artificial intelligence capital. OpenAI paused work on parts of its Astra model, which it had announced only on August 1st, after an internal review found the model had crossed what the company calls a critical cybersecurity threshold. In plain terms, it could independently identify and carry out attacks against well-protected real-world systems. Sam Altman, on Friday, said that given its cyber capabilities, they need a little longer to do this safely. And the company is bringing in government bodies and independent safety institutes before wider deployment. Read past the safety framing, and there is a capital allocation signal sitting in it. Capability is now arriving faster than the ability to safely ship it, and that changes the shape of the return on a frontier training run. If the most capable output of a multi-billion-dollar training run is the output you cannot release, the economics of that run look different. Energy and geopolitics. Brent settled at $82.15, down about 0.4%, with West Texas near $78.84. Strait of Hormuz transit is still unresolved, with Iran and Oman still negotiating terms, and Iran continuing to attach conditions to any reopening. Brent at 82 is a price that assumes the negotiation lands. The negotiation has not landed. That is the cheapest unhedged tail in the tape right now, and it sits underneath an equity market at an all-time high. Market sentiment. Drawing on market and social sentiment monitoring across the last 24 hours, the dominant read on Friday's payroll print was that it clears the way for easing. That interpretation was close to consensus across retail-facing commentary, and it is the single widest gap we can see today between what is being said and what is being priced. On the institutional side, the split runs the other way, with at least one major bank sticking with a hike call despite the weak print, and the widely shared view that inflation now matters more than jobs for the next decision. Positioning and pricing are pointing in different directions. When those two disagree, the pricing is usually the one to trust, because it is the one with money behind it. The TEL, 43.9 against 60.4. Those are the September hike and hold probabilities after Friday's jobs report, and put side by side they resolve the whole day. The market's own pricing says the live question is whether the Federal Reserve raises or stays put. And the assets that rallied hardest on Friday, gold, Bitcoin, long-duration equities, are precisely the ones that need it to cut. That is the gap. It is not a forecast on our part. It is a contradiction sitting in plain sight on a futures screen. Sectors in play, three that matter today: homebuilders and housing finance. The bull case is that mortgages in the mid-sixes are not the binding constraint people assume, and any duration relief helps at the margin. The bear case is that the constraint is a 5.08 times price-to-income ratio, which no plausible rate path fixes. The read is that rate-driven housing rallies keep failing because they treat a price problem as a financing problem. Second, megacap technology and semiconductors. The bull case is the strongest week since April with artificial intelligence, capital expenditure fully intact. The bear case is that top 10 concentration above 40% means the index and the theme have become the same trade. The read is that you can be entirely right on the technology and still be under-diversified by accident. Third, precious metals. Bull, a softer dollar, and persistent central bank demand. Bear. Much of the recent leg was bought on a cut narrative the rate market never endorsed. The read is that the position is more crowded than the thesis is confirmed. On the radar, first and most important, the August Consumer Price Index. That is the actual decider. A hot print rearms the hike, and a soft print is the first genuine cut argument anyone will have. Second, September 14th, when the Senate returns and the Clarity Act cloture vote is queued. Third, September 16th, the Federal Open Market Committee decision, framed as hike or hold, where a cut would be a real surprise against current pricing. Fourth, the yen intervention. Watch whether the dollar defense needs repeating, because repetition is the tell that the first one did not work. And fifth, the Strait of Hormuz talks, where Brent at $82 is quietly assuming a resolution that has not been agreed. The scorecard, 3 new falsifiable calls dated today. Call 69A. If the August Consumer Price Index prints above consensus, September hike odds recross 57%, their level before the jobs report, within 2 sessions of the release. That is wrong if they stay below. Call 69B. The Clarity Act receives a Senate procedural vote after the September 14th return, which is to say the dead for the year framing is wrong. That grades by October 15th. Call 69C, and this is the falsifiable form of today's focus. The national home price-to-income ratio will not fall below 4.5 times within 12 months on any interest rate path. That is wrong if it prints below. We also carry forward call 68A that the federal funds target will not be lower than 3.5 to 3.75% at the September decision. And today's pricing is consistent with it. And one correction on the record. Yesterday's focus leaned on the 10-year yield rising on the weak print. That was an intraday move and it did not hold. Yields fell into the Friday close. The structural point stands. That specific observation does not, and we are not repeating it. The close, the economy lost 23,000 jobs and the stock market closed at an all-time high on the same afternoon. The question worth sitting with is not whether the labor market is weakening. It is why a market that watches the Federal Reserve obsessively spent Friday buying an easing cycle that the Federal Reserve's own futures curve refuses to price. Sometimes the crowd is not wrong about the facts. It is wrong about which number it is actually looking at. We are watching the August Consumer Price Index and whether the yen defense needs a second round. Today's single thesis on why housing was never really about interest rates is in the focus. Link in the description. This has been the Asymmetric Daily Brief. Research and education only, not financial advice. One contrarian read a day. Subscribe.